Good morning, everybody. We'll just give it another minute before we can get started. We see a lot of people still logging in. Alex, can you move to the next slide, please? Good morning, everybody. My name is Shivani Jain, and I'm a partner at SAX. Today, we will be covering a variety of topics, just getting you ready for the year-end presentation. I'll start off by just walking you through some of the Trump provisions and tax provisions, which we think may happen in the upcoming months. Samantha is then going to talk about the BOI reporting, which is essential before the year end, just walk you through some of the nuances, the penalties and the interest which could be applicable. Marnie is going to walk us through some business tax aspects of planning and what you should keep in mind before the year end. Michael and Shimor will follow with the same thing with their year-end planning on individuals, states, and trusts. And then Allison is going to wrap it up with a discussion on what has changed at the state and local income tax level. Before I start the presentation, just a disclaimer from us. Our firm provides the information in this webinar presentation for general guidance only, and it does not constitute provision of legal, tax, or any other kind of consulting or professional advice. The information herein should not be used as a substitute for consulting with professional tax, legal, or other advisors. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all the relevant facts of your particular situation. So with that, just to walk everybody through the tax proposals, which we think, and these have been discussion during the campaigns as well. To start off with is some of the business tax proposals, which are corporate income tax currently is at 21%. There is discussion of having these reduced to 20%. And if you are a manufacturer in the United States, it would go down to 15%. Like-kind exchanges currently is limited to real estate, and this came about with the TCJA provisions. There is talks about extending these provisions and continuing the limitation of like-kind exchanges to real estate only. Qualified business income deduction was set to expire on December 31st, 2025, whereby businesses get 20% as a deduction on their qualified business income. There is discussion of extension of this deduction too beyond 2025. I think this is a big one about the R&D capitalization, where you're required to capitalize all your expenses if they are within the United States for a period of 5 years, and if it's outside United States for 15 years. I think our clients have been dealing with it for the last 3 years, where some of them have had huge add backs of their R&D expenses. Under the Trump proposal, there is talk about restoring the expense deduction in the year it is incurred. So most of us are looking into these details, and the recommendation to our clients is to extend the tax returns for 2024 because we don't know the timing on when some of these provisions may come into place. Bonus depreciation, the phase out began 2 years ago. Right now it's at 60%, going down to 40% in 2025, 20% in 2026, and zero beginning 2027. There are proposals of bringing the 100% bonus depreciation back into play. Individual provisions, the tax rates were set to expire on December 31st, 2025, which means that the highest tax bracket would now be 39.6. There is proposal under TCJA that the tax cuts which came into place would now become permanent. Social Security benefits, 85% of these benefits are taxable to certain taxpayers. There are proposals that all the benefits would be exempt from income taxes. The same with tips. Right now it is subject to income and payroll taxes. Going forward, it could be exempt for income as well as payroll taxes. State and local tax, I think we have gone back and forth on this, and there were certain proposals to maybe double the SALT deduction from $10,000 to $20,000 in some of the previous bills that came out. There is some discussion again that, once it expires in December of 2025, it will not be reinstated. So the SALT cap will go away. From some of the articles which I have been reading, they say that the provision of $20,000 may come back again. So we'll have to see, if it's completely eliminated or again, the cap will be increased to $20,000. This will also play into what we have, at the state level, the BATE deduction or the PTET or the entity level tax deduction. What will happen to those as some of the states kind of change their tax laws to, as a workaround to the SALT deduction. Next slide, please. The other two provisions, came into place with TCJA, where the home mortgage interest deduction was limited to $750,000 of your principal or secondary home mortgage, and then no deduction was allowed for the home equity loan. This provision is set to expire, but there are proposals to extend it as well. The same thing with the child tax credit. Right now it's $2,000 per child on certain dependents that are younger than 17 years, and it was set to expire on December 31st, 2025. There are proposals to increase that deduction to $5,000. State and gift proposals. With the expiration of the TCJA, the exemption would have gone down to almost like half, around $7 million. Now with the Trump proposal, there is discussions that probably the limit of around $13 million per individual will probably continue, and the tax rates would remain at 40%. With that, I'll hand it over to Sam for the international tax and BOI update.
Hi, good morning, everyone. Samantha Geis, I'm one of our international senior managers here, and we're just going to be touching a few things, but predominantly on the Corporate Transparency Act. So this is due this year. This is why it's so relevant right now. Any entity that has been registered with a Secretary of State and has beneficial owners needs to be filed by January 1st of 2025 if they existed prior to 2024. If you have an entity that was created during 2024, you have 90 days from filing the documents in order to file this report. So they're giving a little leeway right now, but they're pressing this as an anti money laundering and keeping track of different things in order to help better the system. So who needs to file? That's always everybody's big question. You should also be consulting with your lawyers on this because it does apply to structuring. But generally, as I said before, it's for somebody who has, or some persons who have an entity that has filed with the Secretary of State, and they have a business, an LLC, S Corp, anything is on the table, trusts. So you really want to make sure that you're looking closely at all of the details. There's also exemptions that are applicable to various entities. Those are detailed on the BOI website. The biggest one and the most significant one is a large operating company, which has a couple of caveats to it, including that you have 20 full-time US employees. There's a physical presence here in the United States. There's more than 5 million of US source gross receipts. Each thing, again, detailed on BOI website, and then we're also here to answer any questions that we can help with, of course. Next slide, please. So what is going to be reported on these forms? So it's very basic information. They want to know the entity name, the address, the jurisdiction, your identifying number, and then who are the owners of this? Their name, their date of birth. You do actually need to upload some sort of ID verification. And then whoever has substantial either control or ownership of these entities is what they're looking for and what they want reported. So when to file, we went over this before, but I'm just going to mention again because the deadlines are important, as Shivani said. Before 2025, if you were in existence before 2024, you have basically the rest of the year. Going forward, you have 90 days. The other important thing to note is this is not an annual form. You file it once, and then within 30 days, if you have an update with an ownership change or an entity change, that's where you need to go back in and update it. The other important piece here is penalties. So there's civil and criminal penalties associated with this. The civil penalty was $500 a day. It's been indexed for inflation, and I think I saw it go up to $591 a day, and there doesn't seem to be a cap on it. So this could get very, very burdensome if these forms aren't filed. Criminally, the penalty can be up to $10,000 and 2 years of imprisonment. So definitely pay attention, take a look through everything, and just make sure you've got your bases covered. Also, New York is potentially doing this as well in 2026 with a similar filing. So keep your eye out for a SAX blast on that, or just some updates coming through. Next slide, please. A few other things in the international space we just wanted to mention. Form 3520 and 3520A relate to foreign trusts and foreign gifts. The IRS is ending an automatic penalty for certain instances of this, which is great. Usually we end up abating a lot of these penalties because there's good reasonable cause. So the IRS is taking some of the burden off of the taxpayers going forward. And what they're doing is they're looking at the reasonable cause before assessing the penalties to alleviate the year or 2 year long abatement process while still getting the IRS notices for clients. Next slide, please. And then some of our sunsetting TCJA provisions, just to keep in mind, a lot of the tax rates for any foreign income related to GILTI, foreign derived intangible income, and then the base erosion tax, they're all going to increase with the sunsetting provisions. The details are here on the slide if you want to know a little more about how they're going up. And with that, I'm going to pass the next mic to the speaker, Marnie.
Good morning, and thanks for joining us today. With 35 provisions from the Tax Cuts and Jobs Act set to expire, effective tax planning is more important than ever. As we just heard from Shivani, extensions or changes might happen, but for now, the key is flexibility, building a tax plan that can adapt as things evolve. Shivani mentioned several of the key tax provisions, and now we will explore them in more detail and provide some tax planning opportunities. Let's start with some of the key provisions that are expiring, then move on to some of the permanent provisions. Next slide. So bonus depreciation has been a big help for businesses, letting them fully deduct the cost of qualifying property. But it's starting to phase out, as Shivani mentioned. It's 60% for 2024, then it keeps decreasing by 20% a year until completely phased out after 2026. A cost-seg study can help businesses maximize bonus depreciation. Quick illustration, if you purchase a $5 million building without a cost-seg study, annual depreciation would be approximately $128,000. If a cost-seg study could carve out $1.5 million of personal property, depreciation in year one jumps to over $1 million, giving you an extra $400,000 in tax benefits in year one. You can also then invest the tax savings and earn interest, farther enhancing the tax benefit. But here's the flexibility. You don't have to perform the cost-seg study in the year the building is purchased. If additional depreciation isn't needed in year one, you can conduct the study in a later year and file for a change in accounting method to claim a catch-up adjustment. This flexibility lets you time the depreciation to when it will provide the greatest benefit. Section 179 is another expensing option. It's a bit more restrictive. It requires active income, has limits on the type and amount of property that qualifies. Now, combining Section 179 with bonus depreciation can really give you some flexibility, especially if you're trying to stay within a certain taxable income range. Remember, bonus depreciation is mandatory if the property qualifies. However, you can make an election out of bonus depreciation with a timely filed return if it would maximize other permanent tax deductions like Section 199A, which we'll talk about shortly. To allow more time for this analysis or to consider how other tax provisions might impact your overall tax strategy, extending your tax return could be a valuable option this year. Next slide. While depreciation deductions reduce taxable income, credits directly offset taxes owed. Let's look at two expiring tax credits. An employer who pays employees while they're on family and medical leave might qualify for the Family and Medical Leave Act credit for up to 25% of qualified wages paid. Some rules: you need a written policy that meets certain minimums, and wages need to be paid while employees are on family or medical leave. You will claim this credit right on your tax return, so it's there for the taking through all of 2024. The Work Opportunity Tax Credit encourages hiring from groups like veterans, individuals with disabilities, the long-term unemployed. This credit can range from $2,400 to $9,600 per hire. Just keep in mind, you can't go back and claim this credit retroactively. So you want to have a process in place to get those forms completed during hiring. Otherwise, you'll miss out. Now, from tax credits to tax deferrals. Qualified opportunity zones allow you to reinvest realized capital gains and defer taxes while supporting community development. Remember, the cash or other property must be invested in a qualified opportunity fund within 180 days of the sale or exchange to qualify. This program sunsets at the end of 2026, but investments made before that date still qualify for deferral. Next slide. The qualified business income deduction has generated significant savings for partnerships, S-corps, sole proprietors. It allows for deduction up to 20% of qualified business income. A quick, simple little example: a taxpayer earns $5 million in QBI in 2024. With the 199A deduction, they can reduce income $1 million, leaving $4 million as taxable income. At 37%, taxes are $1,480,000. Without QBI in 2026, because that 2026 is when it's set to expire, that same $5 million is fully taxable at a higher rate of 39.6%. Now the tax jumps to $1,980,000, a $500,000 increase. So I think that sort of highlights, some of those significant benefits that businesses have been realizing, utilizing Section 179 or 199A since its enactment. It does come with a few key challenges and limitations to keep in mind. Number one, only income from U.S. sources qualifies. If you do have foreign source income, you need to exclude it in the calculations. Number two, the deduction is limited to the greater of 50% of wages or 25% of wages and 2.5% of the unadjusted basis of property. Three, deduction is further limited to 20% of taxable income reduced by net capital gains. Four, for specified service trade or businesses, which are fields like law, health, consulting, the deduction phases out. Once taxable income exceeds certain thresholds, and I have those thresholds noted there on the slide. Next slide. A couple of planning ideas. A key factor in maximizing the QBI deduction is strategic tax planning. By increasing wages, you can raise the limitation and avoid losing out on potential savings. There is an example there on the slide that you can feel free to walk through at your convenience. A couple thoughts related to managing taxable income. Non-SSTBs might consider keeping taxable income higher to maximize the deduction by accelerating income, deferring depreciation, or other deductions. On the flip side, SSTBs can reduce taxable income to remain below phase-out thresholds by deferring income or accelerating deductions. Utilizing automatic accounting method changes can provide significant flexibility in managing taxable income, either up or down, depending on your goal. Combining qualified businesses under Section 199A can help meet wage or property limitations by pooling entities. Next slide, please. Now let's move to the provisions that remain permanent and how they might shape your long-term tax planning. The corporate tax rate was permanently set at 21%, a significant drop from the prior 35% max rate. With C Corps locked in at 21%, an individual rate set to increase after 2025, now is a good time to revisit whether your choice of entity still makes sense, even if you analyzed this back in 2017 or 2018. This decision is nuanced and depends on several factors like federal rate differences, owner cash flow needs, state tax rate disparities, and benefits such as Section 1202, which is a capital gain exclusion, or Section 1244, which allows ordinary loss treatment, and 1202 and 1244 are only available to C Corp stock owners. It's a complex decision with many moving parts, so revisiting your entity choice now could uncover new opportunities as tax law evolves. Section 163J. Section 163J permanently limits the deduction for business interest expense to 30% of adjusted taxable income. For businesses with gross receipts exceeding 30 million, aggregation rules do apply, meaning businesses under common control may need to combine receipts for the 30 million gross receipts test. Impacted businesses should review their debt structure, consider electing out of bonus depreciation, or manage taxable income to maximize allowable interest expense. Section 1031 like-kind exchanges allow for tax deferrals of gains when proceeds from the sale of real property are reinvested into like-kind properties. TCJA limited the scope. It used to be real property and tangible personal property such as equipment or vehicles. TCJA eliminated the tangible personal property. And another item to keep in mind is that not all state laws follow federal. So to be able to maximize the benefit, make sure you're also checking your state laws. Next slide. Under TCJA, businesses can no longer carry back net operating losses, but they can carry them forward indefinitely. Post-TCJA NOLs are limited to offsetting 80% of taxable income in any given year. Businesses should consider accelerating income or deferring deductions to fully utilize pre-TCJA NOLs that had a 20-year carry forward before they expire. Next slide, please. Oh, I'll go through Section 174 real quick. Shivani mentioned the required capitalization and amortization of R&D expenses over 5 years, replacing the previous ability to immediately expense costs. But the R&D credit remains a significant opportunity for businesses at both the federal and state levels. Startup businesses can use the R&D credit to offset payroll taxes. Also keep in mind the IRS has released a revised draft form 6765, which introduces more comprehensive reporting requirements with the tax return. In conclusion, while some provisions are sunsetting, others remain, offering both short-term and long-term planning opportunities. As we've discussed, flexibility and patience are going to be key this year as the tax landscape continues to evolve. By staying adaptable and revisiting plans as tax laws change, you'll be better positioned to make the most of the tax opportunities ahead. With that, I'll hand it over to Michael to walk you through 1040 updates and year-end tax strategies for individuals.
Thank you, Marty. My name is Michael Pemberg. I'm a tax director in the PCS group. And I'm going to be talking about the 1040 updates, some year-end strategies, and so forth. Next slide. So here I'm just laying out the tax brackets for 24 and 25. This is for single. So anyone in 24 with income of $11,601 and above before the next threshold will be taxed at 12%. So basically this chart is basically the starting point. If your income is that or higher, that will be the tax rate for your income. I listed the differences of each, the increase of the limitation for each year, for each bracket. So basically, the highest paying taxpayer, it's a $17,000 increase to 2025 with a limit of 626,351. So if you hit that, you're in the highest tax bracket for a single. Same thing, you go to the next slide. Same thing for married filing joint. Just wanted to list the tax brackets for 24 and 25. You can go to the next slide. And just wanted to list the standard deduction. Obviously, we take either the standard deduction or the itemized deductions. So if you have itemized deductions, which we'll get into in a minute, that exceed these amounts, then you take the itemized. If not, usually we take the standard deduction. And again, the difference is between 24 and 25. Next slide. So Shivani touched upon this in the beginning. Obviously, these are some of the tax proposals by Trump that impact the 1040. Basically, the biggest one is making the TCJA expirations permanent, with the SALT being the exception. If that's the case, and again, this is all, we're going to monitor this obviously next year, but that will, come into play with the AMT, and that will cause, clients prepaying taxes, property taxes back to, 2017 days of, should a client prepay? Are they going to be an AMT? So that's basically one of the bigger items we're focusing on and going to watch closely. And obviously there's exempting tips from income taxes, Social Security, overtime pay from income taxes, and creating an itemized deduction for an auto loan interest. Again, we're monitoring this, and obviously we'll be talking to you guys, our clients, as the year goes on and as we hear more next year. Itemized deductions, obviously no limitation on itemized deductions. Medical and dental expenses got to exceed 7.5% for unreimbursed. The SALT cap for now is $10,000. That includes state and local taxes paid to the jurisdictions and property taxes. In interest expense, mortgage and investment. The mortgage, for a new mortgage, it's limited to $750,000. And investment interest expense is no limitations based on investment income. You need to have investment income for that. And charitable contributions, this is one of the bigger tax planning strategies. The limitations I just listed, 60% for cash of AGI, 30% for long-term capital gain property, such as appreciated securities held for longer than a year, and cash to a private foundation. And then the 20% is appreciated securities to your private foundation. Next slide. So excess business losses, these were extended 2 years through end of 2028. So, any net business losses exceeding those thresholds for 2024 is $305,000 for single, $610,000 for joint. And in parentheses, I listed the amounts for 2025 is $313 for single, $626 for joint. Anything the net business losses exceeding these thresholds will be carried over as NOL, which Marnie discussed just before. Next slide. Just want to provide the FICA Social Security wage base. We see that on the W-2s. That's $168,600 for 24, $176,100 for 2025, and basically the taxes for Social Security and Medicare didn't change. So you can continue to the next slide. Year end's coming up. Obviously, we start thinking about retirement contributions. I listed the retirement contributions for 24, 25. Everything increased for 25 except for IRAs. So IRA limitation still for 25, it would be $7,000. So I just wanted to point that out. If you can maximize, retirement contributions, which I'll discuss in a little bit later. I just want to list out the new thresholds for 24 and 25. Next slide. I thought this was interesting. This is the this slide relates to the 1099K. I see this. We're going to be seeing this more and more often now. The IRS is implementing a $5,000 threshold for tax year 2024, as they're trying to implement a $600 reporting threshold. But for 2024, it'll be $5,000. So what that means is if you received, you sold something as a hobby on eBay or something like that, you sold something on one of these platforms, you would get, if it's over $5,000, you would get a 1099K. If you get a 1099K incorrectly, such as like you got it for something that triggered something, you want to call the issuer to have that corrected. Obviously splitting bill at dinner or something like that is not, subject to taxable. So basically, just want to monitor these 1099Ks. It's basically for people, self-employment people or people, selling items on a platform online that I have seen get these 1099Ks. Next slide. I see a lot of people still doing the energy efficient improvements and credits. So obviously, I just want to list this quick: 30% for solar panels for 2022 through 2032. And then there's a bunch more for under the buckets for the energy efficient home credits, but I just listed a few. $1,200 is per year for the energy efficient windows, doors, installation. So basically, I think doors are limited, so there's certain limitations in that, but the max credit you can get is $1,200 for that bucket. For heat pumps and such and so forth, that max credit is $2,000. Next slide. So this is something, hot off the press, something new for 2024. Form 7217. I'm sure we're going to be seeing a lot of this. There's a draft. It's not final yet. So what this is the partners report of property distributed by a partnership. So if you get property distributed to you by a partnership, you have to file this form for 2024. The concept is to standardize the basis transfers, establish a basis for the property received in the hands of the recipient. And again, this is not done by the entity, but this is done by the recipient partner. So that's why I'm putting it on my slide show, is because we got to report this on the 1040. If you go to the next slide, I kind of took a screenshot, kind of snipped it a little bit as best as I can. I know, you guys probably can't read that, but basically it really just wants you, this is the form. You list was the distribution and complete liquidation. You fill out a few questions on the front, about the value. You answer a few questions. And if you go to the next page, this is where you get into the description. So if you have a client, or if you are a client that has, several K1s receiving, several distributions of property, this is a form that you're gonna have to fill out, your tax account has to fill out for purposes of 2024 going forward. You list the description, what it is, the basis in the property right before the distribution, the fair market value of the property, and the basis distributed applicable in section 732. So just wanted to point that out. Obviously, this is a big new form that I'm sure we'll be hearing a lot of and doing a lot of for tax year 2024 compliance. Next page. Obviously, it's almost Thanksgiving. That means year-end planning. What ideas to do or what to think about? You want to review investment accounts. You want to review your realized gains and losses year to date. Can we harvest losses? You want to be mindful of the wash sale rule. If you want to sell something, be aware to wait 31 days. Maximize retirement contributions if needed. For those who are 50 and older, you can catch up. If you need income for certain reasons to absorb an NOL, like Marnie was saying, you can do a Roth IRA conversion to, one way to accelerate income. A big year-end tax strategy plan is charitable contributions, which I discussed earlier. And, to add, there's donor advised funds. So if it's, right after Christmas or after the holidays and you're like, what do I want to do? You could put it in a DAF, a donor advised fund, and then make a determination later on where you want to give that those funds to. So it doesn't have to be made right away. You can put it in the DAF, get the contribution for 2024, and then make a determination later on. The qualified charitable distributions. I know there's a slide later on that goes into this in a little detail, but this is a tax planning strategy for 2024, 2025. It's basically taking having your IRA up to $105,000 go straight to charity, and therefore it's not deductible, not taxable to you, and the charitable contribution is not deductible. So it just reduces your income from that IRA distribution. Next slide. A few more, tax year tax strategies: maximize health savings accounts and flexible spending accounts. Catch up for those who are 55 and older. QBI deduction that Marty was going into detail. NOLs, obviously, if you have an NOL and you want to absorb it, use it up. Is there any places we can accelerate income for? Disaster loss, which again, I'm not going to go too much into that. RMDs, obviously be aware of that. If you need help calculating your RMD, come to us as your advisor. We can help calculate that for you to make before year end. There's various tax credits. If you have children, the tax credit increased to $1,900 in 2024, $2,000 in 2025. The maximum child and dependent care credit, I just listed it there, and then the earned income tax credit for eligible taxpayers with no children will get $632, and I kind of listed it for 2, 3, and more, and also in 2025. Next slide. And just listed this here for any clients that are New Jersey may not be aware of these small little perks. New Jersey allows a medical deduction for medical expenses over 2% of income, not 7.5%. You get a deduction up to $15,000 for real estate taxes paid on your New Jersey house or property. There's various New Jersey income tax buckets. The max New Jersey income tax bucket, I think it's 10.75. There's if you contribute to a 529 plan, you can get up to $10,000 credit per taxpayer. If you're Pennsylvania, you get $30,000. New York, $10,000. Connecticut, $10,000. There's a $2,500 deduction for principal and interest paid on student loan, a New Jersey class student loan during the year. And if you have expenses like tuition expenses and you could receive a $10,000 deduction for New Jersey. And that's all my part. So I'm going to switch it off to Shmuel.
I think Shimol is having some technical difficulties. While we resolve that, we are going to skip his presentation, go to Allison, and then come back to Shimol.
Okay.
Thank you, Allison.
Can you hear me now? Okay. Okay, everybody. Well, great. Thanks for being here today. I'm excited to talk about state and local tax. As state and local tax, we're always there to jump in and help out whatever happens. So anyway, so as we're talking today, there's a lot of talk about the Tax Jobs and the Tax Cuts and Jobs Act, and everyone's kind of concerned about what happens at the state level when there are changes at the federal level. So there's different scenarios here. So the states either can they either adopt the federal code as of a certain date that's static. They adopt it, and that's the code that they prepare or have taxpayers prepare their tax returns on. Then there's rolling, right? Those that are changed, and the state looks at the Internal Revenue Code as of a rolling date. And then there's some states that are a little hybrid, like the California. In other words, they have a federal code, a state code that follows some of the Fed as of a date, but they have a lot of additional ancillary edits to the, or changes to the code that accommodate certain tax incentives or planning at the state level that they like to accommodate. So, so we'll see as it goes forward what's going to happen at the state level. Can you go to the next slide, please? Okay, so the big thing at the federal level right now for state and local taxes is that tax cap. And right now the tax cap is $10,000, okay? There's talk that it might be raised, it might go away, we don't know. I don't know, I don't think it'll go away, but we'll see what happens. And as Marnie says, we need to plan, we need to look what's going on, we need to be flexible because we really don't know what's gonna happen, right? But anyway, but in response to the SALT cap, the states, enacted legislation. And what they did is they enacted the pass-through entity taxes. So 36 states have adopted a pass-through entity tax so that you're going to be taxed at the pass-through entity level rather than the individual level. So with regard to what I was talking to before, with regards to the adoption of the Internal Revenue Code, there are some states that they're going to set to expire when they adopted the PTAT. So California, Illinois, Oregon, Utah, and Virginia, their PTAT is going to expire on December 31st or January 1st of 25 or 26. The PTAT will not be enacted unless they go forward, unless they enact legislation to do so. There are some states that are going to expires, but there's something in the legislation that says, okay, if it's additionally expanded or in the federal level, it will carry over to those states as well. So, I'm trying to think. I think it really makes sense for the states to keep this and not enact it. I think it's much easier for the taxpayers to pay it at the pass-through entity level than the individual level. So I think this is a good thing. I think from a compliance thing, it's much easier. And also from an AMT level, because if you're not having an additional deduction, it kind of helps at your AMT that you don't have this excessive deduction that may put you over on AMT. So that's where we go with that. Next slide, please. Okay, so now we have some updates at the New Jersey level. One of the things that we've seen a lot, especially in the last couple of years, because people have been moving to different states, a lot of people moving to Florida, we have seen a ton of state residency audits. People leaving New York, going to Florida, New Jersey, going to Florida and such. And then New Jersey just, provided some guidance with regard to this because for non-residents, which I think kind of impacts the whole, how certain stock option compensation is taxed. Because a lot of times people think if they're no longer living in a jurisdiction or no longer working in a jurisdiction, if you have stock option compensation, that's not going to be taxed because I'm in Florida now. That's not the case. So you have to look at when the stock option compensation was granted versus vested, and New Jersey has provided guidance that says if the days you've worked in New Jersey during this period of time will be used to allocate the taxability amount of that stock option compensation. One of the other things that New Jersey has started is they have a tax credit available for artificial intelligence. There's some mechanisms for computing that tax, and in order to get that, you have to get approval from the state, from the New Jersey Economic Development Agency. Now, we can help you if you have that. If you think you're going to be investing in that, let us know. We can look at the expenses and see if and when it would fill into that criteria. So the next thing that's very interesting that's on here is the corporate transit fee. So New Jersey has increased its rate from 9% to 11.5% for those taxpayers that have $10 million or more of income, and New Jersey taxable income, okay? this is one of the highest tax rates of state tax rates in the country. So it's funding for the state's public transportation system, and it's only supposed to be in place for 24 to 28. So we'll see how that pans out, if they really do terminate in 28. But if you couple that with the bullet two items below, New Jersey has been sending out Nexus questionnaires, and one of the items in the Nexus questionnaire, they want to see if you have any other businesses in the state. So I kind of think they're coupling these together because they're trying to see, okay, do you have any other businesses that are going to come in that's going to kind of put you over this $10 million threshold. So if you get a Nexus questionnaire, don't ignore it. Let us know if you have any questions for it, but they're probably trying to encompass, obviously, more of your businesses that may be taxable in the state. S Corp elections in New Jersey, the process has been streamlined. Right now, if you get a S Corp election at the federal level, you just need to give a copy of your federal S Corp election to the state, and then you can hand it over. Okay, so we've seen a lot of PTIT notices from the state coming in that we've been handling, and I think there was something wonky going on at the state level because the tax was due on the 15th, which was a Sunday, and they were getting some notices. So we've been able to help our clients get out of those penalties and interest. So if you have something like that, let us know and we can help you with that. We can go to the next slide, please. Okay, so just a couple of New York updates. New York has a 2% property tax cap. So the 2% cap will stay in force for 2025 in New York. They do not permit a property tax cap in excess of 2%, even if the rate of inflation is above that. The rate of inflation, they said, was 3.3%. So that's a win for the taxpayers. Another thing is, for those of you that may report withholding yourself, if you don't use a third party, there are online changes to the withholding reporting requirements, and that's going to be all online for you in order to file the withholding tax returns. Okay, next slide, please. Okay, so the big thing and the big question we get all the time is, is my company taxable? Do I have to file an income tax return in a specific state? And you think it's a very simple question, but it's really not. It's actually kind of complicated. Some of the things to consider. So there's a federal law, Public Law 86-272, which is enacted in 1959, which details when a company can be subject to income tax in a state. Now, PL 86-272, there's kind of three big prongs to this. That one, it only relates to the sale of tangible personal property into a state, okay? And your sole activity within the state is the solicitation of orders for tangible personal property, and this is only based upon net income taxes, okay? So, so this doesn't apply if you're selling services, if you're selling intangibles, and Public Law 86-272 does not apply on non-income taxes. So you may have to pay tax on them. There's a minimum taxes in some states. There's also some franchise taxes, which are not based upon net income, and there's gross receipts taxes. So even though you don't have a net income tax, you may be responsible to pay a tax within a jurisdiction. So Public Law 86-272 was enacted in 1959. A lot has changed since then, right? As we know, internet is out there, sales are out there. We know that for sales tax purposes, it's changed, right? Years ago, we didn't have to pay sales tax on our purchases on Amazon, and now we do. And that was really the Supreme Court decision in Wayfair. Well, in light of that, the Multi-State Tax Commission, which is an interstate government agency, which tries to get transparency and coordination between the states and how to tax companies, or excuse me, how the states are going to tax people. And in doing this, they've taken a look at internet activities and the implication of income taxes on that. And so there's a thing here. Do your internet activities provide such a connection with the state that it's going to create a filing responsibility for your company? And so, but in doing so, they also need to consider the impact of Public Law 86-272 on that, right? So what the Multi-State Tax Commission has done is provide guidelines of what should not be protected under Public Law 86-272 when performed over the internet. Okay, and so interesting. If your business, if you use a website for non-sale assistance, right? So if there's anything you're doing over the internet that's not related to solicitation, that's a big thing. Like PL 86-272 applies if it's solely related to the solicitation of orders. Well, if you're doing something over the internet that's not solely related to solicitation of orders, then that will actually impact you and have you subject to the income tax in the state. So there's a couple of things to consider, right? Post-sales assistance via chat, sales of warranty plans, accepting job applications. So if you accept a job application over the internet, that's for solicitation, you're not going to break the Public Law 86-272. That's going to be protected. But if it's non-sales activities, then you would have that protected. Another big thing to consider, which is, most people don't think about it, are cookies. If the cookies you put on the computer, if you put a cookie on the computer on one of your customers, if it's just to collect sales activity or sales, something that's going to be used for solicitation, it should be protected. If it's something that's going to help you with production, with anything else outside of solicitation, that would be a presence, and that's going to, you won't have the protection of Public Law 86-272 after that. Okay, so, okay, so I see we're getting down, the time is kind of getting away with us.
So Alison, in the interest of time, what we are going to do is we are going to move back to Shimol.
That's fine.
And,
okay.
Try to, get another shot if we can get his audio back.
Okay, great, thanks.
So at least we get the state and trust piece back.
Hi, everyone. Good morning. Thank you. My name is Shmuel Kalfa, and I am a manager in the Trust and Estate group. Today, I'm discussing the Estate and Gift Tax Post-Tax Cuts and Jobs Act. Next slide, please. So as we know, the Tax Cuts and Jobs Act was drafted by the Trump administration at the end of 2017 and passed into law for 2018. And but with the caveat that it will expire sunset December 31st, 2025. So we're looking at the sunset coming up at the end of next year, roughly in another 13 months. So one of the provisions in the Tax Cuts and Jobs Act was a large increase to the lifetime exemption. It was approximately $5 million, 10 for a married couple, and it doubled. And as of now, we can discuss now where it stands currently. The lifetime exemption for estate taxes right now in 2024 is $13.61 million per person and $27.22 million for a couple. For an annual exclusion, so we're shifting now to the gift tax. You are allowed to annually exclude gifts up to $18,000 per person for 2024. So that means that, let's say myself, I can give as many people as I want in the current year $18,000 each. It could be friends, family, strangers. It doesn't have to have any sort of, there's no limitations on that. It's just $18,000 per person. So that goes estate gift tax free for the year. Looking forward to next year, 2025, the lifetime exemption increases to $13.99 million per person and $28 million around $28 million per couple. And the annual exclusion amount goes up to $19,000. These amounts are indexed for inflation. And that $28 million for next year is the aggregate amount that we've given away during your lifetime and at death without incurring any federal, estate, or gift taxes. Next slide, please. So if nothing changes, the tax law, Tax Cuts and Jobs Act is going to expire, and these tremendously large lifetime exemptions are going to be shipped back to what they were pre-law. So that means $5 million per person and $10 million per person for their lifetime exemption. Indexed for inflation, which brings them around to be around $7 million and $14 million. But we don't know if the Tax Cuts and Jobs Act will be extended. It seems likely due to the fact that Donald Trump is president, the Republicans control the Senate and the House, but we have to plan as if it might not happen. So with that said, also there's no worries about planning aggressively and possibly having a clawback from the IRS, because they've already issued regulations saying that whatever planning you do now with these increased lifetime exemptions will be grandfathered in or locked in for the future. Next slide, please. So just to give a quick illustration, if you pass away with a $20 million estate, where I'm going to talk about the example on the left, with a $20 million estate in 2024, you have the couple, a married couple, 27.22 million lifetime exemption. Assuming that you and your spouse each gave taxable gifts during your life of $100,000 each, you have a remaining exemption of $27,020,000, which with your total estate of $20 million, you get to reduce that by the $27,020,000. So the net estate is zero or negative, and there would be no estate tax due. So there would be no estate tax from 2020 if you died in 2024. However, if you waited and the sunset occurred, and now you're in 2026 and you have a similar estate size, but with a greatly reduced lifetime exemption of $14 million, with the same taxable gifts given during life, you have only remaining, if you look on the illustration on the right, you have 13.8 million of exemption left, which would end up with a taxable estate of 6.2 million, which would trigger a $2,480,000 estate tax. So it's not a good look, and it's something we definitely want to avoid. Next slide, please. So what can we do now? With this looming deadline, we're not sure what's going to happen. We have to remain vigilant. You have to also be flexible. So one good thing is just review what you have in place right now. Check your will, check any trust documents, speak to your attorneys, all your trusted advisors, your accountants, financial planners. Where do you stand right now? That being said, also be flexible. You can start the process of planning as if the lifetime exemption is going to be split in half, 50% reduced. And then you could also make decisions as we see what unfolds in the next 13 months. But also keep in mind that there are reasons for planning other than tax considerations. Asset protection is one reason. Another reason is family dynamics. If you have children that may not be ready to take on your estate in sense of responsibility, planning with trusts and your will and things like that can control the assets when you're gone are a good way to control that dynamic. Also, just last thing, cash flow needs, just keep in mind if you're doing any planning, consider that before year end. Next slide, please. So some simple estate planning methods are just the annual exclusion gift. So like I said, 2024, $18,000. Quick example, if you and your spouse give annual exclusion gifts of $36,000, you split those gifts, and you have 3 children and each one has a spouse, you can basically give $216,000 per year. Let's say in 2024, for this year, $216,000. It'll increase in 2025 because of the index for inflation, but that's a good way of getting a nice amount of cash out of the estate tax-free. Another easy way to do this is outright payments for health and education expenses. It just has to go to the actual institution. So if your son or daughter are going to Columbia next year, paying their tuition directly to the institution would be a tax-free gift. College savings 529 plans is another good way. You get to make the gift upfront tax-free 5 years. So you get those 5 years of $18,000 each. So let's call it $90,000 for 2024. And you get all that also gift tax-free, and the money goes out of your estate. Next slide, please. So a more complicated planning technique could be the spousal lifetime access trust. We also refer to it as the SLAT. This is good for, it's very understandable. You have your estate, let's just call it roughly $30 million estate. You want to plan for the reduction in lifetime exemption, but you're reluctant to give away assets where where you might not have control of them anymore. So, you're on the younger side maybe, and you're like, I don't want to put all this money into trust. I'll never be able to get it back. It's irrevocable. So the spousal lifetime access trust, it allows you to set up a trust for the benefit of your spouse. So let's say, for example, husband sets it up for spouse, and so husband puts, let's say, $14 million into the trust. The spouse gets distributions from the trust. So the money leaves the estate permanently. It's not going to be taxable upon the husband's when he dies, and the wife will still, during the lifetime, during her lifetime, she gets distributions from the trust. So what that does is it allows the money to exit the estate, not subject to federal estate tax, and it allows the wife to receive distributions for health, support, maintenance, education. So emphasis on support, because those are more, and you could also give the trustee broad discretionary rights for distributions. So while the wife is pulling money out of the trust for her own support for during her lifetime, the husband and wife still basically for an indirect benefit to get access to all those funds. So it's something to consider. Next slide, please. It becomes, you just have, it's a completed gift for federal gift tax purposes. There's no strings attached with this spousal lifetime access trust, so it's a good tool to getting money out of the estate while also remaining, while also keeping some access to it. Next slide, please. Irrevocable life insurance trust, with the looming sunset that could happen next year, people want to have liquidity for to pay their estate taxes. So the irrevocable life insurance trust, also known as the ILIT, is a good tool for that. Basically what happened is a husband and wife sets up a trust for the benefit of her husband, or for somebody else, for the beneficiaries, let's call them. The wife gifts to the trust money for the trust to pay premiums on a life insurance policy. The insurance company issues the policy to the trust, and then upon the wife's death, the death benefits get paid from the trust to the beneficiaries. So that provides them liquidity to pay the estate tax if it happens, which with the reduced lifetime exemption there might be estate tax payable, while also keeping the money. The proceeds are not subject to estate or income tax. So it's another good way of planning. Also, just to note that with so many of our clients, a lot of their wealth is tied up in a family business. So if you don't have the liquidity to pay the estate tax, this is another good tool. Instead of disrupting the continuity of the family business by having to sell off some of it in order to raise funds to pay the estate tax, this life insurance trust is a good way to do that. And then next, can you skip the next slide? It's just an illustration. And then go one more. All right, just going to touch on some charitable gifting strategies. We mentioned them briefly before. Donor advised funds, another. Estate planning technique. Qualified charitable distributions is another one that I'm going to touch on. And then there's some other ones I have listed here. Next slide, please. The next slide. The donor advised fund is a great tool for getting money out of your estate if you're in a charitably inclined. If someone, let's say, for example, works for a hedge fund, they're getting a big year-end bonus. And it's coming in on December 31st when you're on vacation with your family. You don't have the time to make those charitable contributions, but you will still get the upfront benefit of getting the money out of your estate and getting the charitable deduction on your income tax return. The donor advised fund allows you to make that large contribution. Let's say you got $1 million bonus. You can move 500,000 of it right away on December 31st to that fund, and then you get the upfront benefit of the deduction on your income tax return with the comfort of having the next foreseeable future to actually have those funds dispersed to the individual charities. Vanguard and Fidelity, they all offer these types of benefits of donor advised funds. Next slide, please. Qualified charitable distribution is another great technique, getting money out of the estate while also getting a taxable benefit. For 70 people 70 and a half years and older, it's a direct donation from your IRA to a charity. The maximum is $105,000 for 2024. And it also, let's say you were 73 and older and you have that required minimum distribution, it's allocated towards that number. So if you have a $300,000 required minimum distribution, $105,000 of it can be going towards a charity, and it wouldn't be included in your current year taxable income. It also wouldn't make any sort of other charitable limitations with your itemized deductions. Next slide, please. Just to note that for estate and trust income tax brackets, the highest bracket this year is 37%, with that getting applied to any income over $14,450. Next slide. And this would be my last slide. Just keep in mind, any planning you do, please keep, your whole team. It's advisable to keep your whole team in the loop. All your trusted advisors, attorneys, accountants, financial advisors, everybody has something good to add, and we all want to help contribute. Thank you, everyone, for your time.
Thank you to all the presenters. I did see a lot of questions come in. We actually ran out of time, so we'll probably get back to you individually, but the slides along with the recording of this presentation will be sent to your registered email within 24 hours of the session ending. So thank you again, and then happy holidays and happy Thanksgiving from SAX family to yours.